Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella, with additional insight from industry veteran Jordan Kimmel. We'll break down the news, trends, and overall direction of the markets, telling you what may be coming next, investment opportunities, and what to avoid. Now, here are your hosts, Dominick Tavella and Michael Hartzman.
Good evening, everyone. This is Michael Hartzman coming to you live from Long Island, New York on Tuesday, February 23rd, along, as always, with my partner, Dominick Tavella, who is once again in sunny Florida. So good for you, Dom.
Yeah, thank you, Mike. Welcome all to another evening. And man, Mike, what a day, what a week to bring this show live. We're always wondering what we're going to talk about next, and is there going to be something interesting and relative to what the real world is giving us? And what a day, what a week.
Yeah, I mean, we always joke around that we never have run out of things to talk about, and we should have named that the show. That should be the name of the show. We never run out of things to talk about report. So, yeah, the activity in the market the last 2-3 days has really been a little schizophrenic, but I don't think overall surprising, and I don't really think overall concerning. I got a phone call yesterday from a younger investor. He's a little bit phonetic about it, and he said, "Well, what's going to happen?" I said, "It was a Monday. What's going to happen? It'll be fine, you know." And today we reversed course. The market actually had a 360 point swing, which again in 2021, that's not an unusual thing. We see those big swings all the time.
And Mike, to our credit, anybody that actually has been watching these podcasts and or some of our other media interviews, we've been talking about that as soon as we got towards this end of earnings period, that the markets would start to search for something else, and likely a pullback would be kind of normal, right? Kind of expected. And boy, I think we hit the nail on the head on that one. Starting with last week, the S&P was negative for the week, first time in a while, and continuing so far this week. But when the positive data, news, noise stops happening, then there's a refocus on the negative. And right now, is interest rates seem to be going higher, and there's a possibility of inflation. And all of a sudden, the things that were working a year ago don't want to work, the FANGs in particular. And ironically, but the things that nobody loved, the unloved part of the market, now all of a sudden are starting to get some traction. So this is the market rotation that we're often talking about.
Yeah, and I know the media needs something to talk about in a 24/7 news cycle. And yes, interest rates are going up, but the 30-year is still 2%. So do you really see a flood of money going into a 30-year product that you're going to get 2% on? So I also think it requires some context.
It's noise, it's conversation, it's what swings these markets around. But again, Mike, we've been speaking about this for a while. We've been warning clients to expect it. And specifically in an interview that I did earlier in the week, we talked about it very publicly, that you need to sell some of your winners, harvest some profits, and maybe buy some things that maybe had not done as well. And voila, here we are, right? We've rotated some of our client portfolios. We're looking forward to talking about that with some of our guests. And so far, so good for us and our clients.
Right. And the headline I saw this morning, well, the reopened stocks are now doing well. And there's always a catchphrase, right? First we had the stay-at-home stocks, now we have the reopened stocks. So, there's always a new catchphrase or a buzz term. But we're going to cut short our conversation for the first segment this evening, because we really have a great guest. We have John Eade, who's the Director of Portfolio Strategist from Argus Research, who's a friend of our firm, and we've devoted more time to him and his insights. So we will be back shortly with John from Argus Research to just really continue this conversation that you and I are having right now.
Absolutely.
So we'll be right
Looking
back.
forward to that.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella. We'll break down the news, trends, and overall direction of the markets. Now, back to the Lebenthal Report.
All right, so I'm Michael Hartzman, and I'm back with Dominick Tavella. And tonight we're thrilled to bring in John Eade, who's the Director of Portfolio Strategies at Argus Research. And Argus is a new friend of our firm, Dominick, but one that's actually been around for 86 years. So throughout my career, I've always heard the name Argus. Really happy to know over the last couple of months, we've gotten to know them better. So John, we're thrilled to bring you in. And before Dom and I jump in with our million questions, why don't you just spend a few seconds and give us some background on Argus Research?
Glad to, Michael and Dominick, and thank you for having me on today. Dominick, I love that sunbeam coming in on your shoulder. I've got a shadow from the 6-foot snowbank outside my window, but good for you. So Argus, Michael, as you said, is an 80-plus-year-old independent financial services firm. We're based in New York City. Of course, we haven't been in our offices for about a year now. We'll get back in at some point. And then we've got offices in London and in Stamford, Connecticut as well. We have 3 businesses, a money management business. We are a registered investment advisor with the US SEC. We also have a financial data business that's primarily run out of our London office. And then in New York is our core independent investment research business with a team of about 20 analysts and strategists covering almost 500 leading US and global companies with buy, hold, and sell ratings. So that's in a nutshell what Argus is.
All right. Thank you for that background. And, I read over the deck that you sent yesterday. And could we just start with kind of your 8 fundamental forecasts and the dumb for 2021? And I guess the dumb question is, I made the comment in our first segment that in the long term for 2021, yesterday was just a Monday, right? I mean, I don't see this great sea shift in the market because you have a day or two where the technology sector gets weak and there's some sector rotation. Do you have anything to add to that? Did you see anything fundamentally change in the last few days, which would get you to change your opinion or your outlook?
Well, Michael, you touched on one of the drivers of the recent volatility, and that's been the uptrend in interest rates. But instead of going over, 8 forecasts, why don't we just go over 1 or 2? And I want to make the point that Argus is bullish on US stocks for 2021. So we are expecting the S&P 500 to end the year up maybe 10, 12%. And that's based on our outlook for a recovery and stabilization in US GDP. We note that while interest rates have risen slightly at the long end, they're still nothing like they were 10, 20 years ago. And 1.35% on a 10-year is not a great return for a long period of time. So low rates are favorable. We just got through the 4th quarter earnings season. We're getting through that now. Results have come in better than expected, and they're going to be even better in the 1st, 2nd, and 3rd quarters of 2021. So you've got those 3 very positive factors. And then kind of putting a damper on a great year for stocks are valuations. And we've seen stock prices rise sharply post-pandemic, even as earnings haven't recovered. So you can't say the market is undervalued here, but we do look for a positive year based on good economic growth, generally low interest rates, and strong earnings, especially in upcoming quarters.
So, John, in just the last week or two, we've seen these high-flying growth stocks, right, the FANGs in particular, that just could do no wrong. And I think for the most part gave us pretty exceptionally good numbers, good strong numbers, top line, bottom line growth numbers. And now they've sold off 10, 15%, in some cases even more. It's hard for me to believe that money managers are going to completely get out of that trade and look to buy the stay-at-home stocks. What are your longer-term views on that?
Well, longer term, Dominic, I think our U.S. economy, and we've thought a lot about this over the past few years, does maybe 4 or 5 things really well. And that's what you should be investing around. One is we come up with great technology solutions. And we see that with all the capital that's flowing in the tech sector today. 2, we're pretty good at research and developing breakthrough drugs. And here we have a lot of vaccines and treatments for COVID-19 coming on. 3, we make some pretty good weapons. Like it or not, the defense industry is something that we do very well. And if you're looking for values in the market right now, you can find a lot of them in the defense sector. The 4th area is the supply chain and consumer-facing businesses. So the consumer sector, we think, is something to latch onto. And the 5th area is what we're doing here. Our country is very good at raising and allocating capital. So a lot of the banks and financial services firms, which are some of those value firms that are doing very well right now, are also well positioned for the long term.
John, when the pandemic started last year, obviously everyone's forecasts had to really, shift on the fly. What did August do around February, March, about a year ago, as it dawned upon all of us that we were going into this prolonged shutdown and this prolonged season of really, the economy being on hold?
Well, Michael, we tried to keep our wits about us, right? We're an 80-year-old financial services firm. I've been at the company over 30 years. My director of research has been there 29 years. We've been through some cycles before. We know cycles come to an end, like the 11-year bull market that we had been in through February 2020. And we know that new cycles start, but then can come to an end as well. And they typically follow the fundamentals, right? The fundamentals of the economy, of interest rates, of earnings, and of prices. So one of the things we were really glad to see in February and the March was the Federal Reserve to step up aggressively and lower rates to zero and start to backstop financial markets and buy longer term financial securities. Then there was also another, more pleasant surprise that Congress actually got its act together and in a bipartisan measure passed the first, COVID Relief Act and injected almost $2 trillion into the U.S. economy. The U.S. economy is about a $21 trillion economy. So they put 10% into the economy right there. You started to get a feeling that the economy would recover because of the 2-pronged action from the government. At the same time, volatility was skyrocketing. And so we were guiding our clients to some of the financially stronger, maybe more mature large cap companies. Our consumer staples analyst upgraded Procter & Gamble and Coca-Cola at the bottom of the recession. Our tech analyst put Intel back on the buy list because we saw these great values in these great franchises. And so we tried to keep our eyes on the fundamentals, the companies with the strong balance sheets and the talented management teams, balance sheets carrying companies through the pandemic, and management teams taking the companies to the other side, were some of the things we were thinking about as the pandemic started to unfold.
Hey, John. So one of the things that gives me a little comfort to agree with some of your year-end numbers on where the S&P might end is the consumer. And, the consumer's been bottled up now, right, for well over a year. And they have, unfortunately, some have been laid off, but for the most part, they have a considerable amount of cash sitting on the sidelines. And when they get that opportunity to spend, they're gonna spend, right? So I'm positive about that and its effects on the economy, but I also worry that there's going to be an awful lot of money chasing a very few amount of goods. I don't think the capacity is going to be up and running on day one. So any inflationary concerns and what that might do to the markets?
I think we're seeing that those inflation expectations start to drive those longer term interest rates a little bit higher. There's not much the Fed can do. They can do a lot at the short end, not as much at the long end. And the Fed has gone on record to say that they'll live with inflation, a little bit above 2%. If that will bring that unemployment rate, which is now around 6.3%, down closer to 4 to 3.5%. I do think that there probably will be some goods inflation, Dominic, like you're talking about, whether that's from higher input costs or higher energy costs. At the same time, another major factor for inflation is wage pressures, and the trends that we've been through recently, with globalization and better trade opportunities have really helped keep wage pressures under control. So I don't see, I certainly don't see us going back to the pre-Volcker years. Almost all the inflation measures we look at right now, and I've got some of them in a chart I sent over to you, 10 of the 12 are below 2%. So maybe by this summer, if more of them are around 2%, that could be a concern. But to your point earlier, at that point, I would expect the unemployment rate to be closer to maybe 5.5% or 5%, the economy to doing very well, and corporate profits to be recovering strongly as well. So they all kind of fit in there together.
John, we agree with you about interest rates staying low at least until 2022. I mean, the Fed has, really indicated that. And I do think Janet Yellen was a good pick for Treasury Secretary, being a former Fed chief. Sure worked closely with Jay Powell pretty well. But looking forward past that, you mentioned the $2.2 trillion that was injected into the economy, and there's more to come. When do we start ever to think about this deficit?
Oh, Michael, I think it's around 125% of GDP now. And in the 80s, it was like 60% of GDP. And, we've got another couple trillion coming down the pike. So we're probably going to be, maybe 140, 150% of GDP. Right now, to your point, it doesn't matter. Interest rates are still very low. Nobody's anticipating the U.S. is going to default on its securities. Most of the debt is owned by people in the U.S. who, just assume that the Treasury will keep the printing presses going. I think total debt owned by foreigners is 20%, and it's not in China's interest to sell or Japan's interest to sell. So we've got low interest rates. The dollar has come down a little bit. It had been at all-time highs in last first quarter of 2020 when there was the flight to quality move into U.S. Treasuries and the dollar. It's come down a bit, but it's still relatively high. So you have that confidence around the world that the U.S. is going to be able to lead global growth on this other side of the pandemic. I think what you would need to see, Michael, is either Europe or China really become a dominant threat to the U.S. And right now, the Chinese economy is, I don't know, maybe 25% less than the U.S. economy. But on a per capita basis, it's like 20% of it. So, there's a lot of lifting of, consumer lifestyles that China is trying to do. That's going to take a generation at least. So I think we've got some runway, Michael, to do the spending here and then fix up the balance sheet, before the globe actually comes and asks us to pay.
So John, I kind of wanted to save this question for last, but I want to give you enough time to maybe give us an intelligent answer. So what screws this up? I think we're on a good glide path towards year end. Vaccinations, economy opening, spending. What screws this up?
Well, we've talked about a couple of factors. We've talked about, maybe inflation does spiral out of control, and interest rates do, perhaps get up to, 2.5 or 3% on a 10-year. That's going to, I think, take a lot of people out of the stock market, right? Because they can get some income now out of bonds. So that's going to, probably drive a hole into this, bull market that we've seen recovering. I'm not really worried about oil prices spiking higher. I think you've got a global secular trend of approaching, peak oil demand that just going to reduce the need for oil, and you're not going to see the kind of supply or demand issues that we've seen in the past. So I'm not worried about oil. We got through the presidential transition, right? That was good news. Maybe, Dominic, maybe the recovery in Europe and overseas doesn't go as well as people like the IMF are anticipating, right? Europe is about to go into a double dip recession here in this first quarter. We're not going to have that in the US. And the vaccine supplies may be slower to get out to some of the emerging markets, and COVID may linger there longer. So I think there could be global growth disappointments as something to be concerned about. But here in the US, I think we're going to have the low rates, the US economic recovery, and the good earnings growth for at least the next few quarters.
John, my last question. And last week we had a guest from JP Morgan, and he was the same situation. He was sitting comfortably in his house, and he was in either Connecticut or New Jersey, and he talked about eventually heading back into the city. So my question for you is, you've been doing this for a year. You look like you're pretty comfortable sitting in your den or your study. Are you anxious to head back into the city? Do you think August is going to bring their people back? Have you guys talked about that? Or do you think this is a new paradigm that a lot of corporate America is going to be sticking with?
We're definitely going to be coming back into the office. Probably not the way we were in the office pre-pandemic, but we've been based in New York since our inception. It's a great place to be, to see our clients in town, to see our clients when they come to visit. Maybe they don't visit in 2021, but they'll come in 2022, 2023. It's a relationship business. It's important to see people's faces, to give them a fist bump, I guess, if that's what we do. Also, we're a company of ideas. We don't make anything really tangible. So the more that we have people coming together and thinking and talking, I think it's easier for our sales team to, really get a sense of what we're bringing to our clients. And I think that strengthens our sales culture as well. Plus, Michael and Dominic, we've been very productive, in our year outside of Argus, but we've got a very experienced staff, and we're going to have to prepare for the day that, people like me or the owners of the firm retire, and we're going to need to bring in a new generation, and we're going to need a place to recruit them and train them as well. So for several reasons, we will be back in Manhattan, but I don't see that until end of the summer at the earliest.
So
And John,
ultimately,
we're running out of time. So one last question for me. You've had capital available, it's liquid. Where's the place you just jump on right now to put it to work?
Well, we talked about defense stocks, right? They're very cheap. They've sold off with a Democrat in the White House. It's a very good industry. It generates a lot of cash. You can get 2 to 3% yields from defense. Also, the banks have kind of gotten out of the bag, right? That it's probably not as attractive anymore. But Dominic, one of the themes that we like is dividend growth, and companies that grow their dividends at least 10% a year. They are rare, but when you find them, they have the strong balance sheets. They have the focus on shareholder returns, and they also have the confidence in their near-term outlook to increase the dividend at a double-digit pace. So those are some of the characteristics that we look for in companies that we like, and that could be like an Old Dominion Freight Lines. It could be a Lockheed Martin, a Nike. It doesn't really matter on the industry, but these have been successful companies delivering successful shareholder returns.
Great ideas. Thank you.
Thank you, John. We appreciate your insight. We appreciate you making the time this evening. And thank you for sharing your wisdom with our clients.
Thank you, Michael. Thank you, Dominic. Have a
Great
nice evening.
Be safe and look forward to doing this again someday.
Thank you.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella, with additional insight from industry veteran Jordan Kimmel.
And welcome back to the Lebenthal Report. It's Jordan Kimmel, Chief Equity Strategist and Portfolio Manager. And it's a privilege to bring on a longtime friend. It's Charles Rotblut, and he is the Vice President over at the American Association of Individual Investors. Thanks for joining us, Charles.
Thanks for having me, Jordan.
Well, you know, I'm a longtime fan, and AAII and I go back a long time. So when we restarted the show, I said, we have to have you on. I do believe, I'm going to let you go through some details, but I do believe you are the nation's largest individual investing group, and with a big focus on education, which I think is so critical. And you do it in a community style in a lot of ways. Why don't you kind of share? It's a nonprofit. It's incredibly inexpensive to be a member. Why don't you share a little bit about AAII, and then we'll jump into some details.
Sure, absolutely. So as you said, we are a membership organization. We have about 155,000 members, most of whom are individual investors, quote unquote, mom and pop investors. We were started about 42 years ago by Jim Clunan. He was a professor at DePaul University. And at the time when he started this back in the late 1970s, he saw a need that there was really a lack of education and resources for individual investors. And so that was the origin. We've since grown mightily since then. We do a monthly magazine, the AAII Journal, which I'm a member of. We have our website where we offer not only education, but useful tools, screening, fund information. We also have a local chapters programs, and we're expanding our community basis, but we also do national conferences as well. And so our goal is to really help individual investors become better managers of their own assets.
Right. And, you know, here we are in the richest country in the world, and people knock our education system. I know it's a pretty good education system, but there's nothing in financial literacy in the younger ages. And it's amazing how I meet investors, Charles, who are really, you know, not well versed at all in the capital markets. And I think that's a shame. And I know that, you know, education is the key. And, you know, one of these days we'll be flying around again. We'll be meeting in person. I think I've spoken at maybe a half a dozen states where you have breakout groups, which I think is just a wonderful opportunity to bring in experts and share their ideas. The magazine itself is great, but I want to also bring up something that you guys have, which I don't think anybody else has, and it's the screening area with over 60 different managers. So, you know, I've written some books. I was profiled for many years, and I wish I didn't ask to come off. It's a longer story, but there's lots of ways to invest, and whether it's growth, value, or momentum, share, you know, this concept of every single month, you could see what these strategies would theoretically pick. Then you can go in and see the factors that go into the stock selection. I think it's an amazing tool.
Yeah, and I know you're like me. You love quantitative strategies, and really our stock screens, they're really filters. So we're looking for stocks that has specific characteristics. And as you mentioned, it might be growth, it might be dividend, it might be positive revisions to earnings estimates. But we looked at both famous investors and also academic and industry research and said, okay, what are they looking for? What's their strategy? And we've tried to really make those strategies quantitatively available to individual investors. So they can go to our website. Members can go once a month, start every month, see everything that's passing. We actually recently launched an A+ investor service for those who want daily updates. That's available. It's a premium, but it's certainly available to those who want more recently updated information. But the big thing about screens, and what I always tell people, is they find stocks with the characteristics you desire. And often screens, as you well know, will lead you to stocks you never heard of. But when you start looking at them, you realize they have everything you want in a company. So I'm a really big advocate of using stock screens. I really think they help investors immensely.
Right. Well, that's what I do. That's what the magnet stock selection process is. And interestingly, I didn't even know it, but I was interviewed, I guess, in 98 when my first book came out. And then a member called me up and said, I'm following you. And I said, where? And I was amazed by it. And, unfortunately, I came off that list. I had a real prominent place in that list for years. And from compliance, because I run real money, real strategies. So I want to mention one of them in particular, because it really dovetails with what you do. And in fact, our last guest talked a lot about it. So one of my separately managed accounts is a dividend growth strategy. And I know you run a whole program on dividend outlook there. And so it's not only capital gains that makes the long-term return of the market. It's a combination of the two. And maybe rather than me share what I do, you share what you might look for in your dividend companies.
Yeah, so we look for our dividend investing newsletter. We look for dividend growth. So we want companies that are increasing their dividends, and we also make sure that they have the financial ability to actually raise their dividends. And it's interesting you brought up dividends because people don't realize, but historically, when you look at the long-term return of large cap stocks, about 40% of it's attributable to dividends.
Right.
Now, obviously, we've seen more buybacks take place, but I always equate dividends to marriage. So buybacks are kind of like you're dating. And if you casually dating and decide, I don't want to be available for Friday night, there's not much punishment.
Right.
But if you tell your spouse, hey, I'm not coming home Friday night, well, there's going to be a lot of pain to pay. And it's like that with dividends. People love their dividends. And if a company cuts a dividend, it's usually a warning sign. But if it's growing its dividend, then it's a sign by management they expect to have earnings and cash flow continue growing in the future to support that higher dividend. So it's a really good characteristic to find in a stock.
Right. And it's a huge source of income around the country. A lot of our clients at Lebenthal, it's not a go-go shop. We really are having people retirement money and they look for income. And, we've been in this lower for longer, 0% interest rates, incredibly frustrating if you're in the bank. But you know what? If you use your screens properly, and I don't want to, it's the name of your title of your book, maybe better, rather than lucky, you'd rather be good. But with the right screens, you find the right balance sheet companies. And, there's a tremendous demand for them right now. And it just makes a world of sense to me.
Yeah, absolutely. And one of the things about bonds, and certainly you have an argument in terms of preservation of wealth, but when you buy a bond, you've locked in that interest rate. It's not going to change. But if you buy a dividend grower, they consistently raise their dividend, and every year, so that growth grows. Maybe it grows 5%, maybe it grows 10, maybe it grows 15, but every year, not only do you have the stock potentially appreciating, but then that dividend perhaps is growing faster than the rate of inflation. So it's not just having increasing dividend, but it's actually increasing more than the rate of inflation. So you're actually being able to buy more with that dividend payment. And for retirees, that's really important.
Right. And you know what? When you wake up in the morning and there's some scary news out and there's something that makes you a little nervous, and in your portfolio, you've got companies raising their dividend 15, 20% per year, paying 4 times what they're paying in the bank right now. You just don't run to the computer to sell your stock. These things are held and they're in better hands, if you will. So let me just bring out something else. I think one of the things that, we export in the United States, entertainment, all kinds of product. I think, one of the things is our capital markets are also the envy of the world. And I know that you're doing work internationally. You have membership internationally. I know you're focused domestically, but specifically, I just want to bring up India for a minute. They are democratic. They're completely interested in investing. I speak to people. Their interest rates are going from 8 to 7 to 6, just like ours did. It's almost 10 years behind in operation. So you have operations in India and around the world as well. Am I right?
Actually, we're all here in the U.S., actually right here in Chicago.
Oh, really? Okay, because
Yes, yes.
thought I saw membership outside the United States.
We
Okay.
do, yeah, we do have some members that are abroad, across the world, actually, which is fantastic. But our office is right here in the Chicago area.
Right. And I've spoken in the Chicago chapter and, again, over it at the school, knee house. I think you have just a great program. I think that I'm not a shill for you guys. I've sold a lot of memberships. I think it's an incredibly reasonable fee. You could just share the fee, and there's an even annual fee. And while you're doing that, I want to ask the engineers to bring on Dominick and Mike, who've been in the business 30 years, and I'd like them to jump into the conversation as well. But share your membership fee, if you will.
Sure. So it's $49 a year, and that gets people the journal, gets them access to our site, our mutual fund guides, our ETF guides, our tax guides. And so there's just a lot there in terms of, as I said, not only information about how to invest, but also the tools to help you actually take that information and invest it yourself. And we approach it all as individual investors ourselves. So we're constantly thinking, what challenges do we have and what challenges do our members have? And what can we do to help them overcome those hurdles?
Right, right. Mike, Dom, want to jump in?
Hey, Charles, how are you? Thanks for joining us this evening.
Charles.
I'm Michael.
My pleasure. It's good to meet you.
Same here. So Charles, I texted Dominick as you were speaking. I said, I have to ask him the first question because I was afraid Dom might steal it from me. During the GameStop ridiculousness 3 weeks ago, here you are, you have this organization dedicated to educating investors, as you use your word, educating the mom and pop investors. And now all of a sudden, you have these guys on this Reddit forum convincing people they could get rich quick. A lot of people got hurt. So I was just wondering what you guys were either thinking or what, more importantly, what you doing to try to educate your members to say, this is not a good idea.
Yeah, so I do a weekly commentary on Investor Update, and I was writing about it, and I brought up 2 points. One was that this is just pure behavioral finance at work where people saw something going on, had to get in it, was worried about missing out. But the other thing I pointed out is that people don't realize just how big the universe of stocks is. So if we rule out all the exchange-listed stocks that are priced below $4, maybe might be delisted, we're still talking 4,000 stocks. And you think about GameStop, and obviously GameStop took the headlines, and we had some other companies, AMC, et cetera. But if you step away from all the noise, you start realizing there's other games to be playing. And I think everyone was so focused on the hedge funds and let's get to hedge funds, not realizing that if you're an individual investor, you don't have to compete against the hedge funds at all. You can go any stock of any size you want, and it means that you can play a different game. And we really try to get our members to think about, don't try to beat the hedge funds, just play a different game. Let them have their sandbox. Let the Reddit people have their sandbox. Meanwhile, there's another sandbox off to the side that's completely uncrowded, filled with bargains. So we try to get people to think about not reacting to frenzy and really thinking about what can I do to my advantage versus let me go on this forum where I don't know who's giving this advice, what they're doing, what their time horizon is. Just step aside from it.
Thank you. All right, Dom, hope you have a question.
Yeah, I made a joke about don't steal my question, but he didn't quite steal it, but the theme is the same. We're a registered investment advisor. We're an asset manager. Everything we do is just core research, documentation, analysis, and then we try to make the best decision possible. But we have a new group of primarily young investors. This is their first time, their first onset into putting money in the market, and they don't seem to be using the kind of tools you offer. How do we educate these people? How do we get them to look at the picture more rationally and say, hey, this is long term, right? This is going to be for the next 50, 100 years of your life. Let's do this in a very logical, fundamental way that can have tremendous rewards for you down the road. How do you do that as an organization?
It's certainly a challenge because they are consuming media just differently. And we're doing things, we've gotten active on YouTube. We just recently formed some Facebook groups. So we're trying to actually go to where they are. But I also think, unfortunately, I think for a certain set of investors, they almost have to make some mistakes before they learn. And they start realizing I need to do things differently. I did see a survey in the last week saying that a lot of new investors are actually starting out and just buying and holding, which is great. But I think, as an organization, we're reaching out. We are doing more things online versus both in terms of video, in terms of our community efforts, trying to actually reach people where they are. So our older audience, older members love reading, love getting our print magazine, which is great. But you have this new generation and they just simply consume media different. And so I think we just have to adapt and realize, okay, here's where they are. Let's come meet them there. And the people who are ready to say, yeah, let me learn a different approach versus following the guys that are talking about sports betting and now talking about stocks or jumping on the Reddit forums. Let me see if there's a different way to invest.
Charles, just to switch gears, speaking of investing, Dominick and I and Jordan have been listening to the death of our business as a result of the robo-investor for probably 10 or 15 years now. And honestly, it hasn't happened. But the younger investor, it does embrace that technology a little bit more. Could you speak to the robo-investor and how many members do you think are using those types of forums to make investment choices for them?
Yeah, that's a good question. We don't have good data on how many of our members actually use robo-advisors. We know about 30% use an advisor. We think most of them are actually using traditional advisors. The robo-advisors, they have a role there. And I think for someone who has absolutely no clue what they're doing and they have a low level of assets, there's a role there. But what I tell people, yes, they're low cost, but the real value of an advisor is often just getting you to stick to your plan. And when you're nervous, you need direction. Maybe you need recommendation for another expert, be it maybe a trust, maybe it be health insurance or life insurance. There's a definite role for personal advisors that you just can't get from an application. And as I like to say, when you're really nervous, an application is not going to hold your hand. You really need a one-on-one for someone to quote unquote talk you off the cliff and explain, hey, here's this plan. Let's go back through your goals and let's think about why you're investing, what your time horizon is. And that's the one thing, although technology offers some efficiencies in terms of cost, a lot of investing is really behavioral, and having someone to help you behaviorally remind you of what you're doing and what your plan is.
Right, Charles, let me jump in here because I think you hit it on the head. And that's really, I think, what Dom was alluding to a little bit too, is that if you have a plan and you have an advisor, it sometimes can be better off than going it your own. And, there's a gigantic change right now in commission structure where trading is free. So there's a modest management fee that you pay, but you could trade, you could buy, you could sell. There's absolutely no friction in cost. There are taxes to pay, obviously. But the main reason I wanted to have you on here is the craziness that I sense going on with the trading on moving averages, trading on group chat rooms. And I know that the focus is at AAII is all about education. So, and now we're all staying at home. So let me just make an offer from my side, from Lebenthal side. If we can help in any way with some more videos, with the groups, I look forward to the days traveling to the chapters again and meeting the group. But ahead of that, make it real easy. Maybe we could do some educational things and help, because to steal the thunder from an old retailer, the educated investor is the best investor. And the more educated they are, the better it is. And I just want to really thank you for joining us, taking the time. And I've had a long experience with AAII, and I think it's going to get even deeper and better.
Great. Absolutely. I appreciate it, Jordan. It was great talking to you, and I appreciate the opportunity.
Well, you do great work when the newsletter comes every month. I love reading it. You actually get amazing contributes, from all around the top experts in the entire field. So you're doing a lot right at a very modest fee, and it's about education. And you're looking well. It's nice to have you on, and we'll talk real soon.
Hey, Charles,
sounds great.
one last plug. If you
Sure.
want to tell our clients how to get a hold of your information, give them a quick shout out how to do that.
Yeah, absolutely. It's really easy. Our website's simply aaii.com.
It's the
Terrific
easiest,
stuff,
easiest
people. Get
address
on
in
it. Go
America,
look at it.
aaii.com.
Yes.
And I have a couple nice articles on there, by the way, when you search.
You do.
I'd like to maybe get back into the gurus. Maybe we talk to Wayne, but thanks for joining us. We'll be
Sure.
right back right after this.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella. We'll break down the news, trends, and overall direction of the markets. Now, back to the Lebenthal Report.
All right, we're back for our last segment of the show, Dom. And what Charles said at the very end, a question I asked about robo-advisors, I just want to expand upon that a little bit. A lot of our clients may not know what that is, but it's just basically a technology that large financial institutions have created that basically cut out you and me. They basically put a computer program in charge of making investment decisions. And as Charles said beautifully, we could have said it better. There's no one there to hold their hand when the proverbial you-know-what hits the fan.
And we literally witnessed it again, Mike. Both you and I obviously been in the industry for over 30 years, and we have lots of experience with this particular subject matter. But last March, we saw a significant number of people, especially over the age of 65, literally exit the market, right? They couldn't take the pain. They did not have somebody to hold their hand or refused to listen to somebody holding their hand. And they, an inordinate number of people, just ginormous number of people exited the market, sold literally at the bottom of the market. And they're still waiting, Mike, for the pullback to buy back in. And not only did they sell at a market that was down 35, 40%, but an S&P that ended up being up double digits for the year. So just the wrong trade at the absolute worst possible time.
Yeah, and I do feel that some of the older, more experienced clients are not really gravitating towards a robo-advisor. But I did have a very successful new attorney ask me the other day. He's an attorney with an investment banking firm in Manhattan, and he actually said to me, "What is the benefit of doing this with you rather than doing it with a robo-advisor?" So, the challenge really, I don't think, is with the retired clients. I think the challenge is with the younger clients who really want more immediate gratification and don't really think they have the time for that interaction to build relationships and get to have us get to know them better to save them from themselves sometimes.
And Mike, I think at least my experience, and I think yours is the same, that, it's also a function of how much money you're working with. When somebody who's at retirement at that point, they're looking at their life savings, their retirement savings, and they understand that bucket needs to be there for the next 5, 10, 20, maybe 30 years. The idea of just putting it into a black hole and letting some robo manager run it without having interaction with a real human being, I think that goes out the window. So I understand when you're younger, you're going to try to do things quicker, faster, easier, maybe new school. But most of our clients post retirement, they'd rather know somebody's looking at the stuff on a daily basis.
Yeah, exactly. And you and I, and we've talked about this, we've had many, many examples when a client approaches retirement. That's when they come to us and say, I don't know what I've been doing for the last 30 years in my 401k. but now I really know I can't screw this up. And that's when they actually do become clients.
And look, this is a blessing. We are all living longer. You're in retirement longer. You need to make the money last longer. So taking silly, frivolous type trades, mistakes is just not in the cards for these people, right? So, obviously our clients are very comfortable with our approach, but just in general, Charles and his organization do the research, do the fundamental work, to make good investment decisions. And if you don't want to do it, if you're bored with it, it's not your cup of tea, then bring in a professional that knows what they're doing, that has a long track record of doing it, and make sure that money does last for a very long time.
Couldn't say it any better. And that's our job, to make sure that no one outlives their money. And on that note, I will see you next week, my friend. Same time, same channel.
Looking forward to it.
Thanks for tuning in to the Lebenthal Report. Dominick, Michael, and Jordan will be back for our next program, airing next Tuesday at 2 p.m. Pacific Time and 5 p.m. Eastern Time on the Voice America Business Channel. Until then, have a great week.